Well, inflation data and the start of second quarter earnings season await as investors the week ahead here. For more on what we can expect in the coming days and what this signals here for the quarter ahead, we want to bring in Jim Smigiel. He's SEI Chief Investment Officer. Jim, it's great to see you here. So let's start with earnings, because we know that this is going to be a huge test for the market. When we take a look at some of these expectations, consensus at least, is for about a 7% drop in EPS from a year ago. How do you see earnings season shaping up this time around?
Yeah, thanks for having me, Seana, and you're spot on. I think consensus is right on that 7, maybe a little bit worse, 7 to 8% year over year. Also a sequential drop quarter to quarter. So the one thing that jumps out at us is it's a fairly, really low bar for this earnings season. We've had a nice kind of run up in the second quarter, compounding the positive first quarter that we had. Really surprisingly strong year to date thus far for equity markets. You combine that with a low bar for earnings season. We think there's going to be something for everyone kind of in this earnings season kind of going forward. But the potential is there for both top side and bottom side, given low expectations.
Yeah, you could argue that with the expectation so low, there is potential for surprises to the upside. We're going to start with the big banks this week. Certainly a lot of focus there about loan losses, any conditions, what could potentially signal what's happening on the macro front as well. What are you going to be watching on that front as potential harbinger of what's to come?
Yeah, I think that financials in general, I think a lot of that kind of news is kind of already priced in. If we look at that, big banks and even the broader financial sector in totality, forward earnings are pretty low. I mean, you're looking at forward earnings for financials in general with a 10 handle on it. So this gets back to my kind of earlier point that I think expectations are fairly low for certain parts of the economy. We think financials are one of them. We happen to really like financials. We do think they represent pretty good value kind of going forward. So we think there's actually a good potential, if you look at that sector in particular, for actually some upside surprises. They haven't really participated as much in the year-to-date rally. And again, with earnings kind of expectations already being low, we think there's some surprises to the upside. It's a sector we like. It's a sector we've been overweight most of the year.
And Jim, one of the big questions this earnings season is whether or not companies are going to still be able to pass along some of those higher costs to the consumer. Goldman was out with a preview this morning for earnings season, saying that the consumer is one of the themes that they are going to be focused on. How much, I guess, wiggle room or ability, power does the company still have in passing along those higher costs? Or are we starting to see maybe more of a balance here going forward with consumers pulling back and saying that, hey, they're not willing to pay even higher prices?
Yeah, I think we're in the early innings there. This is kind of the part of the broader theme that I think we've been talking to our clients about, which is we've yet to see that full flow through to what higher rates means for the economy, for the markets, for individual companies, and for the consumers. Consumers have made this kind of really big shift. We saw lots of demand for goods. We saw that goods inflation out there. We saw that kind of come down to be replaced by services and service inflation. And I think as these innings kind of progress, we think that is going to get harder and harder and harder for the consumer to digest, and then therefore for companies to pass through. So I think we're still in that area of the market where it's going to be like sector by sector, even company by company, as to how much wiggle room they have to pass these things through to the end investor. But we're getting towards the end of that. This is getting much, much more difficult for companies to do that and for consumers to accept it.
We are, of course, watching the tech sector very closely, just given the run-up that we have seen, at least in the first half of the year. How are you looking at that space right now, and just how crowded the trade has become? How significant do you think is the pullback going to be going into this, or looking into the latter half of the year?
This is frothy. There's really no other way around it. The AI, the chat GPT, this has really caught the imagination of investors. This newly coined Magnificent Seven really being behind almost really all of the returns on a year-to-date basis. These names are fully valued. It is an area that we are underweight. We are fading these names. The concentration in the U.S. in particular is something that we don't think is going to reward investors going forward. Look, these are great companies. They've done well. This isn't a tech bubble a narrative that I'm creating here, where we have companies that have no earnings that are just getting kind of caught up in a frenzy. But expectations are so high in this space that we think there's time for a pullback. So this is an area that if you've been in it, good for you. I think that's obviously been a big win. We do think it's time to kind of pull back, get more diversified in your equity exposure. We're definitely that. We're much more diversified. We like things like value and quality and momentum, and we're even a bit more defensive as we look out for the latter half of 2023, holding a bit higher cash.
And Jim, before we get into some of those other plays, just sticking with tech here and the AI theme, clearly the AI rally was driven much of the gains that we saw in the first half of the year. And it seemed like whenever a company mentioned AI in an earnings call, that was enough to get investors excited. What do companies need to show this time around in order to satisfy some of those needs from investors? Do they need to start, I guess, showing how this is translating into profits at this point?
I don't think they necessarily have to. We are still pretty early innings as this relates to it. And it is fair to point out, I mean, the video, they showed how it translates into earnings. I mean, that was a whopping beat of expectations last time. You know, the question is just going to become is how repeatable is this as we move on. Again, we're not trying to talk down the AI revolution. We call it that as well. This is just fascinating technology, the applications of which are going to be extreme. It's going to have a massive effect on the economy and economic growth and potentially profitability. But we're still early innings. Again, this is a little bit of a longer term play. So I don't think there's anything specific. I think we're still in that little bit of a fever kind of part of this leg up. I don't think there's anything specific that companies are going to need to deliver on. But I think it's fair to say that the buzzword of AI will be mentioned multiple times at lots of earnings calls this quarter.
Let's talk about investment opportunities you're seeing outside of the U.S. You've highlighted China specifically, talking about the sheer scale of or size of the market. But, that's an argument that's been made before on China. And I wonder, in the face of slowing growth in the market, in the face of growing political risks, how you make that calculation. At what point does the risk in investing there outweigh the opportunity?
Yeah, it's a great point. It's something that we are constantly weighing as fiduciaries on behalf of our clients. We're looking at China, and no doubt the rebound here has been non-existent. This has been really disappointing news coming out of China. There's some really key differences in how China handled the pandemic as the rest of the world, particularly the developed world. There wasn't really that fiscal stimulus. People weren't getting paid to stay home. But the performance has been, I think, certainly worse than we have expected. I think it's worse than the market has expected, and it may even be worse than China has expected. So we would expect China to begin to look at ways of stimulating their economy. It is, to your point, it is a very big part of the emerging world. But keep in mind, for the typical investor, the emerging world is only about 10% of their equity holdings. So when you look at things from a total portfolio perspective, it isn't going to be that massive of an allocation. So forward earnings in China right now are around 10. Overall emerging equity is around 12. And compare and contrast that with the U.S., which is above 19. We think there's a lot of value in the kind of the secular story of emerging markets in general, and in a shorter term context, specifically around China, as they navigate this kind of less than optimal rebound out of the pandemic.
And Jim, for investors who want to add that exposure to their portfolio, what's the best way to do it?
Diversified, always going to be the best way to do it. That's what we would recommend. So a broad emerging market, as you both have already noted, China's a really big piece of that. But at a 30 to a little bit more than that piece of emerging markets. So stick to the broad-based emerging indices, making sure that we're getting in Latin America, additional areas of emerging Asia, and even emerging Europe. I will put in a little bit of a commercial for active management. While there are a lot of passive ETFs out there, we do think this is a very, very interesting time for active management, a positive time for active management. We think the fees are probably worth it this time around, given this isn't going to be a cycle where we think the beta is just going to be driving returns. we think there's a lot to be made from that security selection, that bottom up, and that's what we would recommend investors do going forward.
All right, Jim Smigiel, SCI Chief Investment Officer, thanks so much for taking the time.
Thank you.